Welcome to Opales TV. Today I'm in Amsterdam together with Jeroen Tielman. He's the founder of IMQubator, a seeding and acceleration platform for alternative investment managers. Now Jeroen, you have been doing this for 5 years, providing seeding and acceleration capital to alternative investment managers. Over the last 5 years, how did this industry change? What changes have you observed?
I think the major change in the last several years, so we started in 2009 with an initial ticket of 25 million euro. And I think one of the changes we clearly have seen in the industry, that such a ticket is not enough. Not enough for a manager to reach a certain skill and momentum. Tickets should be more in the tune of 75 to 100 million dollars instead of 25 million euro. So that's one change. And why is that development has taken place? One of the main reasons is the difficulty of funding climate. Many managers basically need to run their business below break-even for several years. And if that really takes long and there is no momentum in distribution, that can really be a hardship for managers in the sense that they could become distracted. So a start should just really create momentum and not be be a quiet period before they regain or before they get some additional capital. So initial tickets should be larger. Costs also have been increased for managers. We all know about regulatory burdens. And at the same time, that in combination with the difficulty of raising additional assets, where smaller managers are still being seen as something, well, as a specific segment in the market where they really have to fight against the stream of major investor interest only in larger hedge funds. That interest only has increased in the last few years. Access to distribution, it's not really for them to really start their business with a solid ticket, but it's also the expectation for them to raise additional assets. And that can be when they are connected to a distribution platform or to a larger commercial asset manager, where they know that if they're doing fine, they can grow their business alongside the business of the asset manager. So it's not only a larger initial ticket, it's a natural connection to distribution. And at the same time, the distinction between seeding and acceleration is basically, well, somewhat disappearing. We see developments in the market where initial tickets are, well, have such a size that the managers are immediately way beyond 150 to 200 million and are connected to large distribution platforms.
What else have you seen happening in this industry?
Well, we didn't want to find ourselves being a specialist in a quiet part of the river. We want to go to the mainstream in the river. So basically one thing we have observed is that there are some big developments taking place which really require a partnership type of relationship between the capital and the manager. And I can explain that in a minute. And that partnership type of relationship is very interesting in the context of convergence. Convergence between traditional and alternative asset managers. And that is also related to outcome-based benchmarking, traditional benchmarking being replaced by outcome-based benchmarking. One could say that for the retail market, for example, outcome-based benchmarking is a change in product definition. For example, with the DC market going towards target date funds, target income funds, or target capital type of funds like you see happening in the US, which is showing a strong growth. But also in the institutional side, outcome-based benchmarking has seen several dimensions or several definitions. But the basic commonality is that either outcomes are defined in terms of risks or simply in terms of cash flows over time and the likelihood of cash flow over time. So that development of outcome-based benchmarking we see is connected to the convergence. The convergence of traditional asset managers entering into the alternative space and vice versa is really posing an interesting question. For example, if you're a traditional asset manager and you really want to expand your skills into the alternative space, your basic question is, how can I liaise with these specific expertise available in the alternatives market, including hedge, including private equity, including agriculture, farmland, etc. Well, that major question being asked, the traditional choice available in the market is basically, as far as teams are concerned, in or outsourcing. So the lift out of the teams, bring them in their organization. That's one option. We have seen a lot of anecdotal evidence in the market that bringing in alternatives teams in a traditional asset management environment is causing some frictions within the organization, cultural mismatches, back office issues, etc., etc. So we also have seen some cases where traditional asset managers wanting to include alternative solutions or hedge products in their product suite were basically outsourcing that part of their, for example, discretionary mandate to a third party, but basically diluting their added value in that specific part of their mandate. Now that in the context of an increased demand for alternatives, meaning that traditional asset managers should really ask, how can we get close to the specific set of skills and expertise available in the alternatives market, available within different hedge fund strategies, some of them who might have a limited capacity in itself, but might be very interesting because of their totally uncorrelated nature as far as equity is concerned. And that is the reason to begin with why investors have been looking at alternatives. So taking all these things together, the basic question is, how can a traditional asset manager liaise with an alternative provider? Well, besides in and outsourcing, of course, they could also acquire a firm, but if you want to offer a total product solution to your client and you're dealing with two engines in the back, with all types of challenges to make one integrated reporting and to provide a total solution and to integrate two organizations. We think there is an alternative solution which is quite interesting. And that alternative solution is to create a platform so that traditional asset manager could set up a platform consisting of some, well, obviously back and mid office functions. So the platform could be seen as a setup where from the traditional asset manager they have a possibility to connect with external boutique hedge fund managers. And then from the view of the boutique hedge fund manager, if they would get a sizable ticket, like I said in the beginning, of 100, 150 million to start with, and an expectation that if they do well in their performance and the name of the traditional asset manager behind it is a blue chip name with strong in distribution, it could create a win-win situation where on one hand the traditional asset manager would have direct access to the underlying manager, and then there's the creativity, the idea generation, even the line items of their best trade ideas. So that type of granularity can be accomplished in these type of partnership of relationships between a traditional asset manager and an alternative manager, whereas at the same time they stay outside the organization. They still have their entrepreneurial incentive. They still have their own responsibilities. So it's a kind of like solution which could be better than either in or outsourcing or just acquiring an alternatives firm by setting up such a platform and looking for specific niche strategies of which the total could provide a very interesting but also distinguishing and proprietary solution for a traditional asset manager to incorporate in their total discretionary product offering. And as I said in the beginning, with the outcome-based type of investing for traditional asset managers who typically have a very strong distribution brand, it is important to have close access to a broader set of skills and expertise. And we think that setting up such a platform And connecting with specific managers, specific niche strategies would provide a very interesting solution. Now, what is the connection with seeding and acceleration? Well, with seeding and acceleration, typically what the seeder accelerator does is to build, to define and manage these partnership type of relationships with the underlying managers. If we see what we do here every day, every week, every month, is we have very intense contacts with our underlying managers. Knowing what's happening, we know what their particular trading ideas are. So that type of context can be very beneficial for a traditional asset manager to consider.
Now that's interesting. Have you seen any of the other large players or institutions working on such a concept or implementing it?
Well, I guess there are some examples emerging in the market. But one thing we have been been interested in is the Blackstone case. Blackstone announced in June that they're setting up their own hedge fund. And having a closer look at it, it is our interpretation that this platform could be something which I've been just describing, where it is our understanding that they write initial tickets of 100 or maybe 200 million and provide managers with an expectation that they can raise or that they can get access to a larger chunk of capital. I mean, Blackstone is a giant in the market of alternatives, so would be quite attractive for alternative managers, obviously, to connect to, but also to get a connection to distribution. One thing in such a situation, and again it's our interpretation, looking from the outside to it and maybe looking from a big distance to it, but it could also be a setup, and this may be speculative, but it could also be a setup where by getting access to the best trading ideas of the individual managers and also have a allocation within the platform that you get the best ideas of the managers and you can mix and match them for your particular client solutions. You do not only have a menu of different strategies attached to the platform through which you can provide tailor-made risk measure or risk outcome based mandates for your clients, but in the end it also provides you a cost saving, or it provides a cost saving for the institutional investors or the investors associated with it. Because the way I read this platform is that the managers are outside of the organization. The platform is built and designed by Blackstone. For the managers, it's kind of like, seemed to be easy access once they are selected, of course. And that in itself, so the combination of the different strategies attached to the platform, the granularity even of the trade ideas, besides the mix and match of the different strategies, provides a very interesting tool for total solutions for investors. And at the same time, it could be seen as a way to cut out cost layer. If I would compare it with a traditional fund-of-fund model, one can assume that there are two cost levels. And of course, a giant like Blackstone could negotiate them down to the bottom. But this type of model, where you have a multi-strategy platform with managers attached to it with whom you are basically co-stakeholder, could provide a much more effective, much more granular toolset and much more cost-effective toolset as compared to the fund-of-fund model. And this is maybe very speculative, but in the end it could basically maybe a replacement of a fund-of-fund model. And this is also where the blurring of the lines in the industry start. I think we're living in a very interesting age in the asset management industry, where the traditional asset allocation models are being replaced by this outcome-based investing type of benchmarks, where you see, well, I mean, this is already taking place the last few years, obviously, within the alternative sectors with the KKRs of this world. moving to become total solution providers in the alternative side. But this doesn't seem to be the end of it. There seems to be totally blurring of the lines between alternatives and traditional. And this is something which I think we have only seen the beginning of. So the reason why we're so interested in this development is that there are a lot of parallels of what we have been doing. Like I said in the beginning, seeding and acceleration is not somewhere, can be seen as a specialism in the side of the market. But if we're talking about these platforms and the type of partnership, type of relationships needed between the platform and the underlying manager in terms of definition and management, that's where I see a great connection with what we also have been doing through seeding, where we typically have these partnership type of relationships. And these partnership type of relationships basically have different dimensions. Dimension obviously are economics, costs, but also the stake in the manager, the upside economics. It is a governance, but it also, like I said before, the access to creativity and the best brains in the industry, the trade ideas, that you're close to that area as well. So that's basically where I had a recognition in following the market, the basic developments, some of the basic developments in the asset management industry or the alternative industry, that I basically saw this connection with what we have been doing and the importance of the partnership type of relationships, which also have been described in the EMA study in June, but which a seeder or accelerator typically takes much further than what is described over there.